Global markets look quiet today. Prices are moving slowly. Headlines feel lighter, but experienced investors know something important. Markets are rarely quiet without a reason. This kind of silence usually appears when money is repositioning, not rushing, not panicking, just waiting. Right now, the global economy is moving through a transition phase. Inflation is no longer exploding, but it is not fully under control. Growth is slowing, but not collapsing. Central banks are standing in the middle, trying not to make the wrong move. In the United States, inflation has come down from previous highs, but it remains above comfort levels. Because of this, the Federal Reserve is not in a hurry to cut interest rates. Earlier this year, markets were confident that rate cuts were coming quickly. That confidence is fading. The message from policymakers is clear. They want proof, not hope that inflation is under control. In Europe, the situation feels heavier. Economic growth is weak. Consumer confidence is fragile. Businesses are struggling with higher costs and slower demand. European banks are lending more carefully, and when credit slows, the economy slows with it. This creates a cycle that is difficult to break without strong policy support. Asia tells a mixed story. Some economies are stabilizing. Others are still searching for momentum. China remains the biggest question mark. The property sector is under pressure. Exports are weaker than before. Stimulus measures exist, but confidence has not fully returned. Investors are watching China closely, because when China slows, the impact spreads across the world. Stock markets reflect this uncertainty perfectly. They are not crashing. They are not rallying. They are drifting. This is what a waiting market looks like. Large institutions are not making aggressive bets. They are adjusting positions, reducing exposure, and increasing cash where possible. Retail investors often feel bored during these phases. But history shows that boredom often comes before major moves. The bond market is sending quiet signals. Long-term yields suggest concern about future growth, but not fear of an immediate crisis. This tells us that investors expect slowing momentum, not financial collapse. Gold is holding its ground. Long-term concerns like debt, inflation, and geopolitical risk continue to support it, but high interest rates and a strong dollar limit gold's short-term upside. Silver remains caught between two identities. It is an industrial metal tied to economic activity, and it is a monetary metal tied to uncertainty and fear. When silver moves sideways for extended periods, history shows that the eventual move can be sharp. Direction depends on what breaks first, growth or confidence. Crypto markets are also waiting. Bitcoin and major digital assets are moving inside psychological ranges. Buyers want confirmation that financial conditions will ease. Sellers are protecting profits from earlier moves. Institutions are still interested, but they are cautious. Regulation, liquidity, and global policy remain the deciding factors. Banks around the world are becoming more defensive, not because of panic, but because of experience. They are tightening lending standards, reducing risk exposure, and preparing for slower economic conditions. Banks know that when growth slows, loan defaults rise. This caution flows directly into everyday life. Loans remain expensive. Housing affordability is under pressure. Small businesses struggle with financing costs. Consumers are spending more carefully, saving where possible, delaying big decisions. This behavior slows the economy further, creating a feedback loop that central banks are trying to manage. So what happens next? There are only a few realistic paths. One possibility is a slow improvement. Inflation continues to decline. Central banks begin modest rate cuts later. Markets regain confidence. Another possibility is prolonged pressure. Inflation stays stubborn. Rates remain high. Growth weakens further, and then there is the unknown.